Since early 2020, trading volume has nearly doubled. Retail investors are now trading nearly 1 billion shares per day, and that number only continues to grow. One major factor for that insane growth comes from the recent change to commission-free trading. With the ability to trade completely free, more and more new investors have finally dipped their toes into the market. However, despite commissions being a thing of the past, trading still has a cost. And retail investors like me and you are paying billions of dollars per year without even knowing it. Today we're going to discuss the study that brought this all to light and how it can be avoided. Early last year, a couple professors decided to get started trading. They happened to be using two different brokers but trading the exact same stock around the same time. Despite that, they noticed they were getting drastically different prices than one another. Originally thinking it was just a one-time fluke, they continued to trade, but quickly found it was a repeating trend rather than a one-time anomaly. So that led them to a very simple question. Why was one broker getting them better prices than another, and how big of a problem was this? Over the next 6 months, these professors would put those brokers to the test, eventually placing over 85,000 trades at the 5 largest brokerage firms in the United States. They eventually found an answer. However, to understand what they found, we need to start at the very beginning. Brokerage firms are just companies that make it possible for individuals like me and you to buy and sell stock. A few of the popular ones include TD Ameritrade, E-Trade, or Robinhood. Now, these brokers have traditionally made a very large portion of their revenue in the form of commissions. That commission being a simple transactional fee to match buyers to sellers, which in turn brought those brokers hundreds of millions of dollars a year in revenue. You can see here TD Ameritrade alone pulled in nearly $1 billion in just a single year. That was up until Robinhood opened up their doors and started offering commission-free trading to everyone. The larger brokers like TD and E-Trade might have tried to drag their feet, but eventually they also followed suit. By the end of 2019, essentially every broker within the United States had gone completely commission-free. But then how do these brokers make money if not through commissions? How are they able to give up hundreds of millions of dollars in revenue? Now, the bigger brokers actually make money in a number of different ways. That'll include things like margin interest, services like financial planning or management, or even through loans similar to a traditional bank. With literally trillions of dollars under management, they're able to make it work. Now, the smaller brokers, on the other hand, don't have that kind of flexibility. A broker like Robinhood has essentially one stream of revenue alone, and that's known as payment for order flow. This payment for order flow is pretty much exactly how it sounds. A payment given to your broker to route your order to a specific destination. You probably have never heard of this before, and despite calling out Robinhood, pretty much every broker out there accepts payment for order flow. Essentially, when a person like me or you goes to place a trade, our broker is then tasked with finding a counterparty to that trade. Finding a buyer when we want to sell, and a seller when we want to buy. But what you might not know is that counterparty to nearly all transactions is not another person. Rather, it's going to be a large institution, and that'll be generally someone like a market maker like Citadel or an exchange like the New York Stock Exchange. These institutions will actually pay your broker to route your orders directly to them, and they do this because they survive on volume. These market makers and exchanges essentially exist to provide liquidity, and that's really just a fancy way of saying that they exist to make it possible for people to buy and sell whenever they want. They'll essentially step in to take the other side of the trade no matter what. This also happens to be the way they make their money and does come with a certain level of risk. So for taking that risk, they make money off what's known as the bid-ask spread. That spread is simply the difference between the price an investor can buy or sell a particular stock for. And these days, that spread can be as small as a penny per share, which means they're going to need a whole lot of orders to make any amount of money, which happens to be the reason they're willing to pay brokers to route orders to them. They want all the orders they can possibly get their hands on. Now, like I said a second ago, the payment itself is fairly small, only a fraction of a penny, literally a tenth or 20th of a cent. However, when we start to see millions or even billions of shares being traded each and every day, that tenth of a penny really starts to add up. It also happens to be incredibly controversial and has even been banned across Europe. Now, the thinking behind that is if a broker is paid to route an order, what's going to stop them from routing their orders to the place that gives them the most amount of money and not necessarily the place that's going to get their customers the best price? It also happens to be the original theory behind the study, They went into it thinking that brokers were routing their orders to less favorable market makers to make themselves more money, rather than picking the place that offered their customers the best price. What they found, however, was something else entirely. First off, they found that all brokers tested were essentially being paid the exact same amount of money regardless where they routed their orders. Some of them were getting paid slightly more overall, but they were getting paid the same amount of money to send it to Citadel versus Virtue or anywhere else. So not much conflict there if the broker is getting paid the same amount regardless. They also happen to find out that those brokers that don't accept payment for order flow still end up sending their orders to the exact same 6 market makers regardless. So despite not getting paid for it, they were still sending all their orders to the exact same place as all the others. What was probably most surprising was that those brokers that did accept payment for order flow tended to also get better prices for their customers than those that did not. Now personally, just the idea of payment for order flow still sounds wrong, but they weren't able to find any links between payment for order flow and order execution. But despite their original theory turning out to be bust, they did have some pretty interesting results. Across the 85,000 trades that were placed, a very clear and consistent trend became apparent. The numbers down here are going to denote the average price improvement received on a per-share basis for each individual broker. The bigger number that you see, the more money that they save, so ideally the bigger number the better. Looking here, we can clearly see TD Ameritrade came out well ahead of the pack, getting them a better price on average of just over 12 cents per share. If we were to just compare that against Robinhood, we can see it being a difference of over 5 cents per share on average, which might not seem like a lot, only a 5-cent difference. However, across the millions and even billions of shares being traded each day, we're talking about a total of $28 billion per year. That's $28 billion that would go back to retail investors if they had done all of their trades at TD Ameritrade versus Robinhood. But if it wasn't payment for order flow that was causing this massive difference, what was it? Taking a look at each individual broker's order volume per day, the answer starts to show. We can see that the brokers with the largest order flow tend to also get the best pricing from the market makers, which then leads to better prices for their customers. The only real outlier for this theory being Interactive Brokers, which despite being the 3rd largest by order volume, came in dead last in execution. I think if we take a look at it like any other business, it'll start to make a little bit more sense. Keep in mind that large customers always get discounts. It might not be fair, but if Walmart goes out and buys 10,000 pairs of shoes at a time to then resell, they're obviously going to get a much better price than that little mom and pop shoe store on the street, only buying 20 pairs at a time. Market makers are essentially doing the exact same thing, and they're able to do this because they're not required to offer the exact same price to all their customers. So just like any other business, they seem to offer their larger customers a better price. Now, regardless of all of that, regardless of your feelings, the main takeaway being that depending on the broker that you use, the price that you're going to get could be drastically different, even if it's placed at the exact same second. Now, if you don't trade often, this may only add a few extra dollars in savings per year. It could be absolutely meaningless to you, and depending on the other services that your broker offers, they might make up for it in other ways. However, if you are an incredibly active day trader, this could literally add up to thousands of dollars a year in savings, and something to seriously consider. Now, unfortunately, the study didn't give us any insight into some of the smaller brokers that claim to have a better execution than the competition, but you tell me, based on what they concluded, who do you think has the best fills, and what do you think about the results of this study?